Well, the Federal Reserve made its first interest rate announcement of the new year today, and the first during the new Trump administration.
Karen Caifa has a look at what it means for borrowers now and going forward.
The Federal Reserve holding its benchmark rate steady amid lingering concerns about inflation.
In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged.
The slow and steady approach at odds with President Donald Trump's wishes, saying last week he wants the Fed to move swiftly.
I'll demand that interest rates drop immediately, and likewise, they should be dropping all over the world.
But U.S. inflation is still above the Fed's target rate of 2%. With the labor market sturdy and consumers still spending, Greg McBride, chief financial analyst for Bankrate, says the independent Fed doesn't see economic urgency for lower rates.
The economy, from a growth perspective, has continued to surprise to the upside. So there's nothing in the economy that's necessarily compelling the Fed to reduce interest rates or reduce them at a rapid clip.
Amid talk of Trump's tariff proposals that could lead to higher prices and immigration policy reforms that could upend the labor market, McBride says the central bank will continue to make decisions driven by data, not speculation. And borrowers looking for more relief on interest payments will have to wait.
Interest rates are not going to come down fast enough or soon enough to really ease the burden in a meaningful way. If you're carrying high cost debt like credit cards or even home equity lines of credit, many of which are in double-digit interest rate territory, you need to stay on offense, be aggressive about paying down that debt, because you can't sit back and wait for lower interest rates to come along.
In Washington, I'm Karen Caifa.